I want to talk about volatility. And I want to talk about volatility because it is about that time of the year when all manner of peanuts pop out of the woodwork and begin to make all sorts of prognostications about volatility. There's only one problem with this. Volatility is probably the most misunderstood topic in trading, and particularly when it comes to listening to talking heads who opine in all sorts of grandiose manners about volatility. You might hear a statement such as, markets will continue to be volatile. Well, volatile in reference to what? What they were, what they might be? Do they actually have any understanding about what the level of volatility in a given market is? The reason I make that point is that just because something goes up and down does not mean it's actually volatile. So there's a few points that need to be clarified when we talk about volatility. The first is that trend and volatility are invariant. And one of the things I'm actually going to show you in this short presentation is that volatility is not needed for an item to trend. So therefore, by definition, it's not actually needed for a trader to be profitable. So when you hear statements such as traders are desperate for volatility, you can actually make the judgment that that person knows nothing about trading whatsoever, because they don't understand trend, nor do they understand the role of volatility in markets and the information that it is actually conveying to you. So a definition: volatility is simply the speed and dispersion of price. How much, how quickly. It tells you nothing more. It offers no more information than that. So as such, it is in many ways a little bit like a dimensionless measure. It gives you a number, but without actually knowing the context of that number, you're very, very much in the dark. When we think of volatility, when we think of anything statistical, the thing that pops into people's heads is this bog standard bell curve. Unfortunately, we can't actually apply this to shares because it would imply that we end up with negative share prices. Share price distributions are slightly different. They're more often than not referred to as being log normal, which means their tail is shifted slightly. The curve looks different. If you look at the red and green lines on this chart, you'll see they're different. And that's simply a representation of the different forms of distribution you're seeing. In terms of what you can expect from volatility, and options traders should be familiar with this. If you're not, you probably shouldn't be trading options. A volatility displays the capacity for mean reversion. What that means is, think of it as a thermostat. If you set the thermostat in your room to 21 degrees, what will happen is the room will heat to 22 degrees, the thermostat will switch off, temperature will drop to 20, thermostat will switch back on, heat the room to 22. The mean temperature is 21. The temperature of the room is swinging around that point. Volatility displays this capacity so that it swings around its mean value. This is important for options traders because if you buy options at very, very high implied volatility, you're on somewhat of a hiding to nothing because that volatility will collapse, and when it does so, it will bring an options price with it. Volatility has no direction, and this is the point that catches people out continually. If you hear a talking head mention that an instrument has downward volatility, you can be assured of the fact that they're an idiot, because there is no such thing. Volatility has no directional bias. If I buy something at 100 and it has a volatility of 20%, all I know is that that tells me the range in which that instrument might trade in a given time. It doesn't tell me it's going to go up 20% or down 20%. When you hear a volatility figure, it's not actually telling you anything about direction. Volatility also won't tell you how much you may make. And we're back to that somewhat false nexus between volatility and trend. Just because something is volatile or has a perception of volatility does not tell you that you will make a great deal of money out of it. Case in point, what I've done here is I've taken a selection of instruments, commodities, indices, FX, and I've looked at the year-to-date change, but I've also plotted their 30-day historical volatility. The best performing instrument in this population is palladium. It's up about 57% as I'm recording this. One of the worst performing instruments is natural gas. It's down about 22%. But look at the volatility of the two. Natural gas has extreme 30-day volatility, whereas palladium does not. And you can see within this basket of instruments, there are items that do very well with low volatility, items that do very poorly with high volatility, and there's a mix in the middle. The volatility figure itself is not telling you anything other than what the 30-day range of this instrument has been. It's not telling you you'll make a lot or lose a lot. So volatility, in terms of the information it conveys, is really quite poor. There's not a lot in there for traders. You actually have to delve a little bit deeper as you go and begin to look at how volatility is tracked over a given time frame. This is palladium, which is the best performing instrument in our population. On the bottom of the chart, I've plotted the rolling 30-day historical volatility. At the same time, I've plotted the average volatility for 2019. You can see that palladium has spent most of the year with below average volatility. Yet intriguingly, it has had two periods of very, very, very strong trend. At the beginning of the year and in the second half of the year. But both of those periods were characterized by very low volatility. If you were to accept the conventional wisdom that volatility is required for profitability, this would come as somewhat of a shock to you. But the reason this occurs will become apparent in a moment. When we look at the distribution of volatility for palladium, we can actually see it spent most of the year with below average volatility. So it's not a very volatile instrument, but by the same token, it has returned 57% year to date. When we look at natural gas, which had very high volatility of around 62% and a very poor return for the year, we see an intriguing picture in that if I said to you an instrument has a volatility of 62%, you would go, damn, that's really high. But in the context of natural gas, it's really not all that high when you consider that the average volatility for this year has been 50%. So a volatility figure or number in isolation is meaningless. You actually need to map what volatility has done in the past and compare one bracket of volatility, one portion of time, with another portion. You literally have to break volatility down into small segments to get a sense of what it actually means. So if I just tell you something has a volatility of 62% without any form of context, that's meaningless to you. It might sound like a very big number. It might sound like a very big number when you consider that many currencies for this year have had very low single-digit volatility. But comparing across instruments is meaningless because you actually need to compare within the instrument to get an understanding of what's happening. In terms of trend is the capacity of price to display autocorrelation. That is the capacity of one day to be up, the next day to be up, the next day to be up, and the next day to be up. Trend has memory. It has memory for a variety of reasons. The easiest one for people to grasp is that markets are made up of people. People have memory. And therefore, price is very, very slow to often turn around. And so memory is very long-term, as evidenced by this chart of Caltex. You can see that the move in Caltex effectively lasted for 4 years. And to give you a sense of why this occurs, this notion of autocorrelation. Autocorrelation is defined by a thing known as the Hurst exponent. Anything above 0.5 is a demonstration of autocorrelation. You can think of it as a propensity to trend. As to the utility of this to traders, I'm not convinced. And this raises the question of why does volatility enter into the conversation? And it enters into the conversation because the prime motivation of traders remains entertainment. We are entertained by perceptions of volatility. We think we are achieving or doing something if we perceive markets are volatile or if they're seen as volatile. We're actually holding the trader's line against volatile markets and demonstrating how immensely clever we are. But there's a problem with this. The problem with this is we're actually paid by price. You're not paid by volatility. And volatility is in no way predictive, despite what people think. And I come back to the earlier example of, if I bought something at 100 and it has a 30-day volatility of 20%, all that conveys to me is the possible range of prices I will find that instrument in 30 days' time. And I say possible range of prices. It could have price distributions well outside of that in either direction. Simply knowing the volatility is not going to tell you the direction. Trend and volatility are invariant of one another. They share no relationship whatsoever, and this is a point of great confusion with traders. Knowing about one tells you nothing about the other. And this point gets muddled with traders. Traders think that downtrends are automatically volatile, uptrends are automatically not volatile. That periods of low volatility mean the market doesn't trend. This is simply not true, because volatility is idiosyncratic to each instrument. So we come back to this as our primary notion, as the point that is relevant to this little piece. We are paid on price, nothing more. And if you cannot understand how price operates, how price functions, how price trends, and you're obsessed with extraneous features like volatility, and you think that they are conveying something to you that is immensely important, when in actual fact is probably an irrelevancy unless you're an options trader, then your chances of being paid at all are really quite slim.